Good afternoon, and welcome to our webinar, The Tools of Monetary Policy Have Changed. Has your instruction? We're very happy to have Dr. Jane Ihrig and Dr. Scott Wolla joining us today. Dr. Jane Ihrig is a senior advisor at the Board of Governors in Washington, D.C. Jane has been an economist in the Federal Reserve System for over 20 years, with the past 10 years working in the division that supports the board and the Federal Open Market Committee in their discussions about monetary policy. Her research focuses on how the Fed's monetary policy actions affect the economy, including the project with Scott on improving econ education materials for teachers and students. Dr. Scott Wolla is an economic education coordinator at the Federal Reserve Bank of St. Louis. He has been an economic educator at the St. Louis Fed for 12 years, producing classroom resources and providing professional development for teachers and professors on topics related to economics and the Federal Reserve System. Prior to the St. Louis Fed, Scott was a high school history and economics teacher for 14 years. Okay, so Dr. Wolla.
All right, well, welcome everyone. So I just want to tell you a little bit about our motivation for doing this webinar today. So over a decade ago, the Fed started implementing monetary policy with ample reserves. You'll be hearing more about that in the presentation. But probably more important for a lot of the teachers on this call is that starting this fall, the AP economics exam is going to include the ample reserves regime as part of the test questions. And they have been introduced into the course and exam description into the benchmarks. And so there are a lot of people out there that are looking for information both about how monetary policy is implemented and how to teach it. And we hope to address that. So the question that I'd like to pose to teachers on the line is, do you know how to cover this material in your classroom? And if not, you're at the right place. And so on the next slide, one of the Fed's primary functions is to conduct the nation's monetary policy. We think of this really in two stages. So first, the FOMC conducts policy primarily by setting the target range for the federal funds rate to keep, and the focus here, of course, is to promote the dual mandate, which is maximum employment and price stability. And then the Fed uses its policy tools to implement policy. That is to ensure the setting that the policy rate is transmitted to financial markets and that the economy moves toward the dual mandate. When we think about the tools, we're talking about the implementation of policy. So on the next slide. Before 2008, the Fed implemented monetary policy with limited reserves in the banking system. The global financial crisis occurred, and after this point, the Fed uses ample reserves in the banking system to implement policy. And we'll be covering that in greater detail as we go through the presentation. But now let's take a short walk down memory lane. So transport yourself back to 2008. I'll ask you, what do you remember about this time? You might remember that George W. Bush was president of the United States. He was ending his second term. On the next slide, you might remember that superhero movies were big. The Dark Knight starring Christian Bale and Heath Ledger was a top movie for DC Comics. In the Marvel Universe, the first Iron Man movie was released, and Pixar's WALL-E showed us how a movie could charm us, even with very few words. Next slide. 2008 was an election year. So Barack Obama, US Senator from Illinois, was running for president. His running mate was Joe Biden, then a US Senator from Delaware. And on the next slide, you might recall that we were in the midst of a global financial crisis. So stresses in the financial system had built up gradually over 2007 and 2008 as mortgage troubles and recession fears increased. The stock market peaked around mid-2007 and fell through 2008. Then, of course, there was the housing market. After rising rapidly for nearly a decade, housing prices peaked nationally the summer of 2006 and then fell rapidly. And since much of the wealth of households is composed of their stock market assets plus the value of their home, most Americans suffered a large decrease in their household wealth. And in 2008, the Fed stopped using its policy toolbox from the limited reserves regime to influence the federal funds rate. And the tools in that old toolbox were open market operations, the discount window, and reserve requirements. On the next slide, I'm just going to take a few minutes and review what that limited reserves regime looked like. So prior to 2008, the Fed was operating with limited reserves in the banking system. In that framework, the Fed's tools work like this. The federal funds rate was determined in the federal funds market. Like other markets, the rate was determined by supply and demand. Here on the graph, you see that the federal funds rate is at the intersection of supply and demand. Reserve requirements created a steady demand for reserves and kept the demand curves downward sloping. It eventually flattened out because at some point banks don't need any more reserves, payments, or additional cushion. And because banks shouldn't be willing to pay a higher rate than the discount rate for funds, the discount rate acts as a ceiling for the federal funds rate. As such, on the graph, the demand curve is capped by the discount rate. Then there's the supply curve. Okay, the Fed controls the total level or the total supply of reserves in the banking system, and the Fed could influence the supply using open market operations. So when the Fed wanted to lower the federal funds rate, which is what you see on the animated graph here, it would do an open market purchase of government securities that shifted the supply curve to the right. Specifically, the curve would shift to the right, or reserves would increase as the Fed credited the account of the seller of the security. So graphically, a relatively small rightward shift of the supply curve would result in a lower federal funds rate. So again, because reserves were limited, the supply curve intersected the downward sloping portion of the demand curve. And you see this on the graph here. The Fed could fine-tune the federal funds rate using very small adjustments to the supply of reserves. Also, you see that pretty well on this graph, that the supply curve is just shifting slightly, and you get a relatively larger impact on federal funds. The Federal Reserve made these adjustments daily to keep the federal funds rate near the target set by the FOMC. So there was fine tuning that went on a daily basis to make sure that the federal funds rate was near the target. But then something changed. And this is where I pass the baton on to Jane.
Thanks, Scott. So as you can see on this graph, what changed was the global financial crisis that Scott mentioned, and then the subsequent recession. So when the crisis hit, the first thing the Federal Reserve did was it lowered the target range to near zero, so 0 to 25 basis points. 25 basis points is 1/4 of a percentage point. So it used its standard policy tool to conduct policy and brought the Fed funds rate, or in short-term interest rates, to near zero. And of course, at the time, with the global financial crisis and stresses in the housing market, the Fed implemented a large number of emergency facilities. And that helped to calm financial markets, but there was a subsequent long recession. And with the target range near zero, the Fed then brought out what was then a new tool, which was large-scale asset purchases. And what the goal was with those purchases, by taking securities out of the public, it helped to lower long-term interest rates and then help stimulate the economy that way. So over quite a number of years, from 2008 to 2014, the Federal Reserve bought a large quantity of securities, Treasury securities, and agency mortgage-backed securities. Now, when the Fed purchases securities, this is an open market operation like Scott discussed. When we purchase securities, we then credit the banks for the securities we purchased. Well, we credit the banks by putting funds in their reserve balance accounts held at the Federal Reserve. So on the graph on the bottom, you can see reserve balances got boosted by quite a large amount when these large-scale asset purchases were conducted. Prior to the crisis, reserve balances were under $100 billion, and at the end of the large-scale asset purchases, reserve balances were over $2.8 trillion. So the amount of reserves in the banking system went from a limited amount to what's at the time some people called a super abundant amount. On the next slide, you'll actually see that the large amount of reserves in the banking system wasn't just because when the global financial crisis hit, but more recently with COVID as well. So the first arrow there at the end of 2015 was when the Fed wanted to raise the policy rate. The recession was kind of over, the economy had recovered. The Federal Reserve said, hey, we want to raise interest rates. Well, now with this blue arrow, you can see we're not in a limited reserve anymore. We have $2.8 billion of reserves. So the Fed had to think about how to operate with an ample amount of reserves in the banking system. And then I just extended this graph even a little further to show you what's happening today. You can see reserves have never gone back to the old limited amount. They've always been ample. And in fact, with COVID happening, again, the Federal Reserve turned to large-scale asset purchases because of the big negative shock. And you can see when we went to lift off interest rates off zero again in March of this year, they stood at $3.8 trillion in reserves in the banking system. So we've had ample reserves in the banking system for quite a number of years. So the next slide shows us how to think about it in terms of graphs. So the left-hand side of this slide shows you the supply and demand figure before the global financial crisis when there were limited reserves, what Scott was talking about, the downward sloping demand curve and the supply curve intersecting the downward sloping demand curve where there was limited reserves in the banking system. Now let's look at the right side. That's where we are kind of today. This is where we were in December 2015 when we had recovered from the recession after the global financial crisis. It's also where we were in March of this year, where after COVID and interest rates were near zero. So we still have a downward sloping demand curve, but now the supply curve is representing a very ample level of reserves. So it's way to the right in the curve, and you can see it intersects the demand curve at the flat portion. Okay. So now the old tools of open market operations, where you move the supply curve a little bit to the left or the little bit to the right, are not going to affect the Fed funds rate anymore. And you can see that. Look to the right, move your supply curve a little to the right, a little to the left. Your Fed funds rate, where it intersects supply, it intersects demand, is just not going to change. So what are the new tools? Okay. The next slide kind of in a nutshell explains how the Federal Reserve operates in an ample reserves regime. Okay. So the demand curve looks somewhat similar to what Scott showed you. It's a downward sloping demand curve. Okay. Now the key is the supply curve is way to the right where the reserves are ample. Reserves are ample means it's intersecting where the demand curve is pretty flat. Small movements in the supply curve really aren't going to change the Fed funds rate where the intersection is between those two curves. What's important now with ample reserves is now we're focusing on interest rates. So Scott talked about open market operations and changing the supply or quantity of reserves. So limited reserve regime, think of in terms of quantities. Now with an ample reserve regimes, we're really focused more on interest rates. And you can see those interest rates with the green arrows on the y-axis. So there's three administered interest rates, or administered interest rates meaning rates that the Federal Reserve sets. Looking at the top of the y-axis, we still have the discount rate. But then moving down, we now have other important rates. So interest on reserve balances, IORB, is a key rate that the Fed now uses to set policy, to implement policy. And then the second interest rate is overnight RRP, or overnight reverse repurchase agreement rate. And so this kind of is the nutshell, but now we'd like to take some time and walk you through all the key tools that the Fed uses with ample reserves.
Jane,
So
I'd like to pose a question from here in the chat. May relate to this information you're displaying. Someone asked, is there a level of Fed funds rate that corresponds to ample, i.e. zero or near zero?
No, that's actually a really good question. So ample reserves is just the amount of supply, the supply of reserve balances is in system. And we'll show you later that with ample reserves, you can hit any Fed funds rate that the FOMC wants to target. And you can kind of see that this year we've been having ample reserves and we had near zero, and now we're over 2%. We'll show you more of kind of the actual data in action a little bit later. But no, so ample reserves is just the amount of it, the amount of reserves in the banking system is more an indication of what are the key tools the Federal Reserve is using to make sure we can move the market-determined federal funds rate to where the Federal Reserve wants it.
Okay, thank you. And another question that came up. So from a student perspective, to simplify, ample equals where demand is flat, or not determined by the rate any longer?
So, so whether you're in a limited reserve regime or an ample reserve regime, all that really means is does the small change in the supply, would that affect the federal funds rate? And as you can see on this graph, if you move the supply curve a little to the right or a little to the left in this figure, it's not going to change the federal funds rate label on the y-axis. It's going to stay exactly where it is. So ample versus limited is really just where the supply curve is intersecting the demand curve.
Thank you very much.
Okay, so this slide says, okay, now that you have ample reserves, what's the new toolbox? What are the key tools? Okay, and on the left, we have listed their interest rate on reserve balance, or interest on reserve balances, overnight reverse repurchase agreement facility, the discount window, and open market operations. Now, 3 of those tools, which are highlighted in green, have interest rates associated with them that the Federal Reserve sets. Now we call those administered rates because the Fed administers or sets them. So interest on reserve balances is the tool, and it has an interest on reserve balance rate that the Federal Reserve sets. The overnight reverse repurchase agreement facility has an overnight RRP offering rate that the Federal Reserve sets. The discount window, as everyone always teaches about, whether you're limited or an ample reserves, has a discount rate, has a primary credit rate, a secondary credit rate, and a seasonal rate, but we'll just call it the discount rate. And then open market operations, instead of being interest rate focused, is quantity focused. And that's kind of playing a role in the background. If you only have time in your classrooms to teach one of these tools, the key tool is interest on reserve balances. So on the next slide, let's now talk a little bit more about what that is. Okay, so this is the primary tool. Remember, banks have accounts at the Fed, just like you have a checking account at your bank. Banks have a checking account at the Federal Reserve. Those checking accounts are called reserve balance accounts. Okay, the funds that banks hold in the reserve balance account will get the interest on reserve balance rate. So that is kind of the key tool and rate associated with the tool that's used to move short-term interest rates, and in particular, the Fed funds rate, into the FOMC's target range that they will set. Okay, so it's the key. So if teaching in class, what message do you want to get across? Interest on reserve balances is the key tool. It has an associated interest rate that the Fed sets so that the market determined federal funds rate moves into the FOMC's target range. Okay. Now, since this is kind of the key rate, we want to make sure everybody understands how it works. So on the next slide, you'll actually see the 2 economic concepts that help drive market rates to where we want them using interest on reserve balances. So Scott, why don't you go ahead and discuss these concepts for us?
Right. Thanks, Jane. So these are the 2 key concepts, and we think there are really 2 key concepts for teaching about why interest on reserve balances are, effective for adjusting the federal funds rate. So the first one there is reservation rate, and the definition is just the reservation rate is the lowest interest rate that banks are likely willing to accept for lending out their funds. Interest on reserve balances acts like a reservation rate, meaning that banks always know they can put their excess funds in their accounts at the Fed and earn the interest on reserve balances rate. So it is the lowest rate that banks are willing to accept for lending out their funds. The other one is arbitrage, and this one is really key as well. So defining our terms, arbitrage is the simultaneous purchase and sale of funds, in this case, in order to profit from a difference in interest rates. So it is because interest on reserve balances is always there, and banks can arbitrage against other market options that the federal funds rate and other short-term rates end up close to the interest on reserve balances rate. And I'm going to show you an example here in just a minute. So let's take a closer look at each of these concepts, and we'll start on the next slide with reservation rate. So to understand the concept of reservation rate, let's consider what banks do with their excess funds. So like any investor, they seek a return on their money. In this scenario, we're going to assume that the bank has three options. They can deposit their excess funds at their Federal Reserve Bank and earn interest on reserves, or the interest on reserve balances rate. They can lend excess funds to other banks in the federal funds market and earn the federal funds rate, or they can invest in treasury bills and earn the treasury bill rate. On the next slide, you'll see the scenario here. And let's assume that interest on reserve balances is offered at a higher rate. Please, there we go. So now let's assume interest on reserve balances is offered at a higher rate, in this case, 2.5%. Than the other two alternatives. Remember that banks seek the highest return, holding risk constant on their money. And remember that interest on reserve balances is a risk-free option that's always available. So in this case, if you're the bank, it seems like a really easy decision. On the next slide, you'll see that the bank will deposit their funds at the Fed and earn the interest on reserve balances rate. So point number one is this: interest on reserve balances is a risk-free investment option for banks. Because they seek the highest return for their money, they will not lend or invest for less than they could earn by depositing at the Fed. So interest on reserve balances serves as a reservation rate. But what happens to the other rates? Well, that's where arbitrage comes in. We're going to find that arbitrage will cause those rates to move up. So let's look at this concept a little bit more on the next slide. And here you see a scenario where the federal funds rate is 2% and the interest on reserve balances rate is 2.5%. We've narrowed our investment options to two. And so let's assume that the federal funds market is saying that funds can be traded at 2%. And the Fed is saying banks can deposit and earn interest, their interest on reserve balances at 2.5. Given this scenario, if you're the bank down there at the bottom observing this, you might see an opportunity to profit. And how? Well, arbitrage. So in that next slide, you see how banks arbitrage, right? So the bank will see that it can borrow funds in the federal funds market at 2% and deposit those funds at the Fed for 2.5%. Okay, earning 0.5% or 50 basis points on the transaction. On the next slide, you'll see that this bank isn't the only one that's taking advantage of this opportunity. Other banks will see that they can also profit, and they will start to borrow in the federal funds market, deposit at their Federal Reserve Bank, and the increase in demand for funds in the federal funds market will put upward pressure on the federal funds rate and push it up to the level of interest on reserves. In other words, these transactions will continue until banks no longer see an opportunity to profit. So point number two is that arbitrage ensures that the federal funds rate does not fall far below the interest on reserve balances rate. In fact, arbitrage is the reason why these short-term rates remain closely linked to the interest on reserve balances rate. Let's look at the other scenario on the next slide. And here we have a situation where the federal funds rate is higher than interest on reserve balances. And arbitrage works in this scenario as well. So banks will also see an opportunity to profit here. And on the next slide, you'll see that banks will withdraw from their reserve account and lend in the federal funds market and take advantage of this arbitrage opportunity. In this scenario, again, we see the profit as 0.5% or 50 basis points. And then on the next slide, this will continue. Other banks will see this opportunity as well. The increase in the supply of reserves will push down on the federal funds rate until they are the same, until any gap narrows. So again, point two is that arbitrage ensures that the federal funds rate is linked, or any gap between the federal funds rate and the interest on reserve balance rate is narrowed or diminishes because banks see opportunities to arbitrage any difference. And I'm going to pass it back to Jane to start on the next slide.
Thanks, Scott. I saw a couple of comments who's setting the interest on reserve balance rate. And just to remind everyone, it's an administered rate set by the Federal Reserve. Okay, so if you're a teacher and you need to teach what's happening in the ample reserve regime, here's kind of a key summary slide of the material we've taught so far. So the FOMC is setting the target range for the federal funds rate. So in the back of their mind, they're trying to move the economy towards their goals of maximum employment price stability. It's doing that by setting a target range for the federal funds rate. Okay. When that target range is set at the exact same time, the Fed is setting a level for the interest rate on reserve balances. Okay. And what we were just walking through, Scott was explicitly talking about arbitrage and reservation rate. The Federal Reserve knows that because those economic concepts are in play, that as it moves the interest rate on reserve balance rate, it's going to encourage market interest rates to move as well. Okay. So this slide on the left, the bottom panel on the left, talks about what happens when the Fed tightens policy, and on the right, it talks about what happens when the Fed loosens monetary policy. So let's just focus on the left side. Let's suppose the Fed's tightening monetary policy, kind of what it's been doing since March of this year. So the FOMC will meet. Whoops, can we go back a slide, please? The FOMC will meet. So on the bottom left panel, it says the FOMC is going to, if it's tightening policy, it's going to raise the target range. When the FOMC raises that target range, it's most likely going to raise the level of the interest on reserve balance rate. And that action then will cause the Fed funds rate, which is in the market, to move up into the target range. So the next slide actually shows how that's been working over the past decade or so. So on this slide, you can see first, let's look at the gray range. That's the Federal Open Market Committee's target range. It's been 25 basis points wide, so a quarter of a percentage point. On the left, you can see during the global financial crisis, it was set near zero, that range. In December 2015, the economy had recovered enough that they moved the target range up. And then they moved it up for a number of years. Then there was some the outlook didn't look as well. So then they moved it, started moving it down a little. Then the COVID shock hit and we moved it back down to zero. Now the economy is worried about inflation, and policymakers have been moving the target range up quite rapidly on the end. Okay, so that's the gray area. Now, when the FOMC sets the target range, it's setting the interest on reserve balance rate as well, and that's the black dashed line in the figure. And if we look at the left side of the diagram back in 2015, 2016, you can see the interest on reserve balance rate was set at the top of the target range. Okay, they chose the top of the target range so that the federal funds rate, the red line, was in the target range. And you can see it was very effective. The red line is in the gray area. Now, if you look over time, let's look at kind of the peak in 2019, you could actually see that because of market pressures, the Fed funds rate started actually to move up in the target range. And so the Federal Reserve lowered the interest on reserve balance rate from the top of the target range towards the middle. So the interest on reserve balance rate, the Federal Reserve sets it, and it sets it so that the federal funds rate, the red line, is always trading in the target range, the gray area. It's been doing it effectively for a number of years. All this without talking about purchasing and selling of securities. Okay, so that's the key tool. On the next couple slides, I'd like to talk about other tools that the Federal Reserve is using. So a second tool that it's using is something called the Overnight Reverse Repurchase Facility with its overnight reverse repurchase offering rate. This we can think of as a supplemental tool. So banks earn interest on reserve balances. Banks are the ones that have reserve balance accounts at the Fed. But the financial market has expanded over the years, and there's many other large financial players in the market. So this overnight, which we call RRP facility, is reaching out to a large number of other institutions that are major players in the financial market. And so just like the overnight RRP rate is offered to banks, the overnight RRP rate is offered to these non-bank large financial institutions. Money funds are a large player in this market. works the exact same way that Scott mentioned for the overnight RRP, for the interest on reserve balance rate. On the next slide, I wanted to mention the discount window. I'll be very brief because this is a interest rate that the Fed has set for a long time, has always been at the top of the demand curve. Again, this is another administered interest rate that the Fed sets. This interest rate sets a ceiling for the Fed. So this is when banks actually need funds, they would come to the Fed and borrow from the discount window. So the interest rates at the bottom of the graph are when banks are placing funds at the Fed, whereas the discount window at the top of this is when they're borrowing funds from the Fed. Okay, and the next slide kind of puts these three administered interest rates into an automated graph for us. So how does an ample reserve regime work? Demand curves downward sloping. The supply curve is to the right in the graph and intersects the demand curve where it's flat. This graph shows what happens when the Federal Reserve raises interest rates, tightens policy like it's been doing this year. What does it do? Okay, it's going to increase the target range, and then the Federal Reserve is going to set the interest on reserve balance rate, the overnight RRP rate, the discount rate. It's going to move them up because it's tightening rate, wants interest rates to rise. Raises those rates. When it raises those rates, the demand curve at the end points shifts up. Nothing's happening to supply. No open market operations are happening, but just because of arbitrage and reservation rate concepts in economics, the market rates will move up as well. On the next slide, I wanted to mention open market operations is still a tool. It's not the primary tool. As we discussed on the last slide, the administered interest rates are moving. I didn't mention anything about moving the quantity of reserves in the banking system. Okay. But open market operations are still there, kind of in a day-to-day sense. We have to make sure the supply curve stays ample, far enough on the right to intersect the demand curve where it's flat. And so there's some factors in the economy that can drain reserves over time. And if that's the case, the Fed would do an open market operation and kind of push that supply curve, keep it ample. Okay. On the next slide, I just wanted to mention in the current ample reserve regime, reserve requirements are not needed. They don't play a significant role. In fact, in March of 2020, so over 2 years ago, the Federal Reserve set reserve requirement ratios to 0. So this is an inactive tool. So you can see on the bottom, and you know, kind of a standard Fred graph from the St. Louis. If you plot required reserves, you can see they actually drop to 0 because the reserve requirements are set. The reserve requirement ratio was set to 0. Basically, the tool was inoperative now. So to summarize, what are the key tools in an ample reserve regime? You can see them in the next slide. Okay, there's 4 of them. The 3 green ones have associated interest rates that the Fed sets. Interest on reserve balances is the primary tool you want to talk about with your students. If you have time, talk about the overnight reverse repurchase facility, and then mention the discount window. Open market operations are there kind of in the background for day-to-day use when we're raising interest rates. So just to kind of hit home how things are working, why don't we look at what's been happening just this year, right? So in March, the Fed lifted the target range from basically the effective lower bound. At that time, there were $3.8 trillion in reserve balances in the banking system. What did the Fed do since March when it's raising rates? It didn't do any open market operations. It raised the target range for the federal fund rate, and then it raised its administered interest rates. Okay, so it raised rates in March, it then raised rates again in May, June, and July. Okay, never using open market operations. Okay, and if you look at the next slide, you can see what I just took a picture, kind of a more narrow window, starting. You can see, whoops. You can see that the Fed funds, if you look to the right, you can see this year when the FOMC has been raising the rate quite rapidly, okay, the gray region's moving up. You can see the interest on reserve balance rate, the black dashed lines kind of in the middle of that gray region, the Fed funds rate which the FOMC wants to target, that market determined rate is staying in that gray region. And then I'm also showing the what's called a repo rate in here. It's called Secure Overnight Financing Rate, a SOFR. And it's a broad measure of the cost of borrowing cash overnight, collateralized by Treasury securities. It's a very popular rate used by many financial institutions today. So this is not the rate that the Fed targets, but it's an overnight rate, very similar to the Fed funds rate, but it's secured by Treasury securities. And you can see the blue rate is moving along with the Fed funds rate. So the point is, even though the Fed targets the federal funds rate, other short-term interest rates move along because of the arbitrage and reservation rate and interaction across markets with many of the same institutions. Okay. So with that, I'd like to pass it back to Scott and talking about how you want to teach this in your classroom.
Thanks, Jane. So we do have some teaching recommendations. We always use this flow diagram when we talk about monetary policy. It's a great way to talk about how the FOMC conducts monetary policy by setting the target range. That's box 1. The red arrow is where the Fed uses the tools. That's the implementation. So if the FOMC raises the target range, then in the red arrow, the Fed would increase the interest on reserve balances rate. And then we flow to box 2. That affects interest rates and overall financial conditions. So that higher federal funds rate would then transmit to other short-term and long-term interest rates in the economy. And that flows into box 3, which influences consumers and producers' spending decisions. And box 4, that moves the economy towards maximum employment and price stability. Number 1 here on our teaching recommendation is focus on the Fed's administered rates. So interest on reserve balances is the primary rate. And so if you're going to do like a real simple approach to this, focus on interest on reserve balances. If you want to kind of do the full treatment and include the other rates, we do provide resources where you can do that as well. Teach reservation rate and arbitrage as the primary teaching concepts. I've been talking to AP teachers, and arbitrage is not in the benchmarks, which means you don't have to include it in your instruction. I think it's a good thing to keep in your back pocket for the student that says why. Why will increasing the interest on reserve balances rate raise the federal funds rate? Because the federal funds rate is a market determined rate. And the answer is arbitrage, that when the Fed raises interest on reserve balances, the federal funds rate will move as well. And we know it will move because if it doesn't move, people will use arbitrage to take advantage of the difference in the rates, and that in effect will move the rate. Number 3, refocus monetary policy decisions away from how the Fed influences the money supply and toward how interest rates affect the decisions of producers and consumers. The next slide is actually for AP teachers who still have a lot of money supply models in their teaching. This is what we tell professors. I actually go back with the, sorry. This is when we talk to professors, we really encourage them to move away from money supply models, the money multiplier. It's hard, right? Because a lot of macro textbooks are kind of built on this foundation of money supply, but we're really encouraging people to move towards interest rates as the method or the mechanism by which the Fed sets policy and through which those policy decisions transmit to consumers and producers in the broader economy. And then number 4, link monetary policy to the aggregate supply and aggregate demand model. It's kind of a natural way to talk about policy. The Fed monetary policy works through aggregate demand. It's a demand-driven model, and so it's a great way to model this in the classroom. On the next slide, thinking specifically about AP teachers, the new benchmarks have teachers teaching both limited and ample reserves. Jane and I have been doing this presentation quite a bit over the last 2 years, And we think it's a pretty natural fit to tell the story that Jane was telling at the beginning, where we did this limited reserves regime, where we shifted the supply curve back and forth to adjust the federal funds rate. Then the financial crisis happened. At that point, the Fed introduced ample reserves and the new tools. And by using a method like that, you've really taught both of the strategies, or both the methods. And we have a number of resources on the website that will help you kind of walk through that scenario. Focus on interest on reserves as the primary tool. I think the AP has interest on reserves, and also discusses interest on reserves as an administered rate, and then link monetary policy to aggregate demand. The flow diagram below is similar to the one that Jane and I use when we talk to teachers and professors, but this one I actually pulled off the presentation that was provided by the College Board. So it aligns really well with the College Board approach to the ample reserves regime. On the next slide. So I just pulled the College Board has a great video that kind of introduces some of this concept. So I just pulled a few screenshots into the presentation. Their model is very similar to our model. It has all the essentials are there. We have the quantity of reserves on the horizontal, the policy rate on the vertical. They use a policy rate to kind of generalize, so it's not specific to the Fed. Of course, here in the United States, the Federal Reserve, our policy rate, the policy rate of the Federal Reserve is the federal funds rate. And then we have the supply curve on the flat part of the demand curve, which is, the signal that this is a central bank operating in the ample reserves regime. On the next slide, this is, again, a clip from the video where it shows the central bank raising and lowering the policy rate by shifting the demand curve higher and lower. And again, similar to our description, the supply curve is in that ample reserves region, and the supply curve is remaining stable. It's the demand curve, the ends of the demand curve, that are shifting higher and lower. On the next slide, I want to tell you about our teaching resources. So Jane and I have been busy for 2.5 years now, writing lots of articles and developing lots of teaching resources. And we want to make sure that that they're available. This is our webpage, Teaching the New Tools of Monetary Policy. If you Google it, it should pop to the top, hopefully. If not, the URL is here, and we'd be happy to send it to you as a reminder. This is a long web page. I just clipped the top, classroom resources, and you see some of the articles that we published as well. The classroom resources, the first one there, how does the Fed use its monetary policy tools influence the economy? This is a short page 1 economics article that's student friendly, that goes over the basics. The next one, the lecture guide, is just that. It includes both slides and a guide that kind of gives you all the vocabulary and all the wording you need to go through this content. We have a short video series. These are 4 short videos, approximately 4 to 6 minutes each, that kind of walk you through the treatment. This is intended for students. The Fed's new monetary policy tools is an online module. I have a screenshot of it coming up, and we built a monetary policy timeline, which shows the evolution of monetary policy since the founding of the Fed. If you want to go to the next slide, please, Andrea. This is screenshots of 2-page ones that I think you'll find useful. The one on the left is longer. It's the Fed's new monetary policy tool. We refer to this one as the primer or primer, depending on where you are in the country. This is a fairly long article. It's really intended for teachers, professors who want to get a lot of background information. We all like to know a lot more than our students when we walk into the classroom. That's the purpose of this article. The one on the right is the one you could send your students to get a good overview. So it's much shorter, less detail, but they're going to get all of the basics. On the next slide, this is the lecture guide I mentioned. On the right-hand side, you see the actual lecture guide. This is, directions, click to slide 5, and it gives you the verbiage and everything you need to teach the content. We also include the slides. In fact, a lot of the slides you saw today are also represented in the slides that go with this lecture guide. So the animated graphs that you saw, a lot of the diagrams, the flow diagram, all of that is included in this slide deck. And then we also have a study guide that you can provide to your students. It's actually more of like graphic organizers to really get students to think about the content and organize it both in their minds and on paper. On the next slide, we have an online module. So if you want your students to get the content, but you don't want to get your hands too dirty on learning all this stuff first, this is like the low stakes. You assign them. Everything is contained in the module. There's a pre-test, post-test, there are interactive pieces, but they're going to get all of the essential content. On the next slide, we built an FAQ page. Actually, this just went public, I believe, this week. And so as we do these presentations, we find ourselves answering similar questions over time. And so we're trying to capture those questions on this page. So it might be a great place to start if you have questions. And on the next slide, we have built a badging module. So this is an opportunity for you and or your students to learn the content and to earn digital badges and a micro-credential. We have two versions of this, one for educators, so you can use it as your own professional development. A lot of people have taken this and they've given great feedback, and they said they learned a lot and it was a great experience. It is very interactive. A lot of the resources you've seen have been kind of plugged into this experience. I've also had several teachers and professors say they want their students to do this. So we created a different version called a Citizen's Guide to Monetary Policy. And they'll get a similar treatment, but a little less teacher talk along the way. And so if you assign this to your students who would earn digital badges and a micro-credential at the end, and these are great for social media or putting on a resume as an indicator of professional development. On the next slide. And I would be remiss if I didn't tell you to go to our website. This is the St. Louis Fed website. We have over 500 free teaching resources, lots of monetary policy stuff, but lots of other resources, K to 12 and college. In fact, if you want to subscribe to our newsletter, you click the little button here, and I think there might be an animated clicker there. There we go. You click subscribe, and then it takes you to the next screen, which if you click is here, and then you click get quick alerts, and then you select what kind of alerts you want to receive. So the only information we ask from you is your first name, last name, and email. And I selected a few here that might be good for this audience. So for instance, the Econ Lowdown newsletter comes once a month. We'll keep you up to date on what we've got and what's new. Page One Economics is a great publication. I've talked about a couple articles already, and either high school or college level resources. Click those, and you'll get an alert when we have a new resource that fall in those categories. And I think that next slide might be where we say the end, unless you have questions.
Thank you, Jane, and thank you, Scott.